All right, today we're going to dive into a pretty big shift in India's financial world. We're talking about a new rule book from the Reserve Bank of India, and it's for the thousands of companies that, well, they aren't exactly banks, but they sure act a lot like them. So let's get right into it.
You know, this whole thing really starts with a simple but super important question. Just think about it for a second. Does it really make sense to use the same super heavy rulebook for a small, local lending company that you'd use for a massive, nationwide financial giant? Well, the RBI decided the answer to that was a clear no, and that's what kicked off this entire change.
To really get why the old one-size-fits-all system just wasn't cutting it anymore, we need to take a look at the incredible variety you find within this group of financial players we call NBFCs.
So what in the world are non-banking financial companies? Well, to put it simply, they're businesses that offer financial services just like a bank, but they don't actually have a banking license. And trust me, they are absolutely vital for getting credit and other services out to parts of the economy that traditional banks might not always reach.
And we're not talking about just one type of company here. Not even close. The term NBFC is this huge umbrella that covers everything from modern peer-to-peer lending platforms to specialized housing finance companies, all the way to microfinance institutions that serve rural communities. They are definitely not all the same.
And you can probably guess, this huge diversity created a real regulatory headache. Slapping the same set of rules on every single one of these companies, well, it was kind of like using a sledgehammer for every single job, whether it needed a delicate touch or some serious force. It was just inefficient for the little guys, and maybe more importantly, not nearly strict enough for the big ones.
And that brings us to the RBI's really elegant solution, a much smarter, more tailored approach called scale-based regulation, or SBR for short.
The whole idea behind SBR is one simple word: proportionality. Instead of having just one set of rules for everybody, this framework creates different levels of regulation. Basically, the bigger you are, the more complex your business is, and the more risk you represent to the whole system, the tighter the rules are going to be. It's regulation that actually fits the scale of the company.
But what's the end game here? I mean, why go through all this trouble? It's not just about making rules for the sake of making rules. It's really about two absolutely critical things. One, protecting the money of investors and depositors, and two, making sure the entire Indian financial ecosystem stays stable and healthy.
Okay, so how does this actually work in practice? Well, the SBR framework is structured kind of like a pyramid with four very distinct layers, and we'll start right at the bottom.
At the very bottom, we have the base layer. This is the foundation of the pyramid, and it's where the vast majority of NBFCs live. These are usually the smaller companies that don't take deposits. Because their potential impact on the whole system is pretty low, the regulatory touch here is much, much lighter.
Now moving up a level, we get to the middle layer. And as you'd expect, the regulation gets a bit more serious here. This layer automatically includes any NBFC that takes deposits from the public, doesn't matter how big they are, plus the larger companies that don't take deposits. More size and more complexity means more scrutiny. Simple as that. Near the very top is the upper layer. Now, this is reserved for the real heavy hitters, the largest and most interconnected NBFCs out there. We're talking about companies that are so big, so important, that if they ever got into trouble, it could send shockwaves through the entire financial system. The RBI specifically picks these firms out and puts them under the highest level of supervision.
So what's at the absolute peak of the pyramid? Well, a document from the RBI puts it this way. The top layer is, quote, ideally expected to be empty. You see, this isn't a regular category. It's more like an emergency zone. If an NBFC from that upper layer starts posing an extreme risk, the RBI can move it up here for the most intense supervision you can imagine. It's a powerful backup plan that hopefully they'll never actually have to use.
So we've gone through the structure, but what's the real-world impact of all this? Why does this new framework actually matter?
It really all boils down to three main goals. First, proportionality. It makes sure that smaller firms aren't being crushed by rules they don't need, which lets them grow and innovate. Second, it means better risk management because regulators can focus their energy on the biggest potential threats. And all of that leads to the ultimate goal, a more stable financial system for everyone.
This really brings us to the big picture and what this all means for the future of financial regulation.
In a nutshell, the scale-based regulation framework is all about moving away from a rigid one-size-fits-all approach to something way more intelligent, way more dynamic. It's about having the right-sized regulation for a financial world that's getting more and more complex every single day.
So, this framework is a fantastic answer for the challenges we see today. But, with technology and markets changing at lightning speed, it leaves us with one last critical question to chew on. As finance keeps evolving, how does regulation keep up and maybe even stay one step ahead?